Tim, good morning, sir.
Good morning, guys. Boy, you cover it all. Now, today is
Hockey too.
hockey.
Yeah,
It's
hockey.
that's
Stanley
you've
Cup
got a
Finals.
We got
wide,
hockey,
diverse base of knowledge in this
Ketchup
group.
chips.
ketchup, Cheetos, stocks.
We talk it all.
Yeah. Anyway,
And then we bring on you for our market structure expertise. What's up?
Well, it's another Monday followed by a weekend in Steamboat Springs, where yesterday afternoon a bear walked across the river in downtown Steamboat Springs, and right, you just never know what you're gonna see. And unlike much of the country, it's been chilly and wet in Steamboat the last few days. It was maybe 65 degrees yesterday, and so this bear was very reticent to step into the water, but the bear crosses the river, and there are 10 or 15 people watching. I got some good video of it, and the river is the Yampa River. And here's the funny part. So the bear, is not bothered at all by any of us watching him cross the river, and he comes up the other side, and then one of the young local gendarmes pulled up in a police car and got out, and the bear went, "Cops!" and took off running. So even the bear knows that it's all fun and games until the police show up. So
the bear is running from the cops. He's not bothered by anybody else, but the police show up and he's out of here.
That's it. Yeah, it was
how that bear. I thought bears were extinct. I thought they were
in this market.
Yeah, right. They are when it comes to market structure. That's absolutely right. But they're alive and well and roaming about in Steamboat. So that's good, I guess.
You let us know if they start to come out in numbers here, and we'll start to really to really lighten up our portfolio.
Tim, no, I saw that you wanted to talk about. Saw your email and stuff, and
yeah,
I don't want you to have to stoop too low for the content on our show for our audience or anything. So, but go ahead, take it away with your research.
And by the way, I did a Benzinga boot camp over the weekend.
Yeah, I was going to mention that. Nice job.
Thank you very much. Well, don't let it get back to Andrew Lebos, but we had well over 100 people subscribe to Market Structure Edge through that.
Nice.
So I hope something was beneficial out of that, and I'll hit a couple of things later in the program about that, but because I want to break some news here.
Ooh, we like breaking news.
On Benzinga pre-market prep.
We love breaking news.
Which I don't think anyone has figured out. Not that we're, it's not that we're geniuses, but we know a lot about market structure, and we spend a lot of time looking at the data. The big thing last week, Joel, to answer your question about where things are, it was, of course, the conclusion of the Russell rebalances. So for those who are fairly new to the markets, there are index rebalances that occur periodically. The S&P, Standard & Poor's, Dow Jones, S&P is a combination now. They will generally do quarterly rebalances. So those occurred a week ago, June 18th. Then MSCI will do periodic rebalances, and then you have FTSE Russell. So the London Stock Exchange owns the Russell indices now. But when you put these groups together, plus the NASDAQ and some others, but people don't realize this, there are over 2 million global index products, and those things rebalance. And so it's crazy, right? There are way more indexes than there are underlying products, which tells you that there's a lot of overlap. So with the U.S. Equity market now very near 50 trillion in market cap, when you rebalance those instruments, it's a big deal. And in the Russells, the cutoff now, this is the thing that I found extraordinary, that the cutoff between the Russell 1000, and it's a simple market cap index, folks. They just rank the top 1,000. So to make it into the top 1,000, you have to have market cap of 5.2 billion. So, which was a 73% increase from 2020, by the way, when the bar was about 3 billion. Isn't that something? Yeah, it's really something. So that's where the money is About 95% of market cap is in the Russell 1000.
Right.
And the Russell 2000 is only about 5%, give or take. That can fluctuate, but about 5% of market cap. And of course, we've got 4 companies that have $1 trillion of market cap now. So Google joined that group, but Amazon, Microsoft, and Apple. Facebook, by the way, is closing in $968 or so billion. That means if they add $12 a share, they're in that group. At a price of about $341.5 right now. So it's just interesting that almost $5 trillion of market cap is in 5 stocks. And what does this mean to you traders? Well, it's what we talked about we always talk about this, that it's about supply and demand, that stocks move on the basis of supply and demand. So you want to know where these things reside. And there are a couple of the so-called meme stocks that the Reddit mob has chased. And I hope some of you folks are listening to the Benzinga Pre-Market Prep Show, because you'll learn more about how things work. So AMC did not make it into the Russell 1000, even though its market cap is 27 billion and the cutoff is 5.2 billion. And you would say, well, how could that be? Why would AMC be excluded? Well, because they benchmarked it. Most people don't realize this. They benchmarked May 7, and they change that date every year. And then there proceeds a period of rebalance activity. A lot of that occurs in the month of June, because they don't want to cause big ripples in the marketplace. And so GameStop made it, because its market cap at May 7 was above 5.2 billion. And AMC's was 4.8 billion. Interestingly, and you look at AMC, it went from $2.01 per share to start the year to $54.06 where it closed Friday, a gain of 2,590%, and yet it's still in the Russell 2000. So all of this stuff, folks, it's important to understand the market that you're going to trade in. You ought to know. And about $11 trillion of assets had to reshuffle. That's all the money pegged to these indices to reflect how the indexes are now comprised. And it's just really interesting. I want to show you something, actually. I'm going to share my screen.
Hey, Tim, just before you do that. So they don't care if companies make money, right? I mean, basically. Right. I mean, so
it's
to
all
me,
based on market cap.
Yeah, it's all based on market cap. So I was looking at some of these companies, and we were going through them. And I mean, I don't want to be like an S&P snob or anything, but I mean, some of these companies are just horrible, and they're never going to make money. A lot of them, I mean, do companies ever like come in one quarter and then go out the next quarter? I mean, I looked at
all
like
the time.
Well,
in the yearly,
not
yearly.
In the
yearly. I mean, I don't know. I mean, how much faith can I don't know. I that's just me. I mean, I know S&P has their criteria, making money 4 quarters in a row. So there's no criteria that all market cap.
Market cap.
Wow.
It's all market cap. Well, and you're
shaking my head.
Joel, it's a very good point, but it goes back to the changing nature of the equity market. If you go back to when I started when I started in this profession back in the 1800s, because I'm getting old.
Are you older than Joel? Anybody's older than Joel.
So 1995, 1995, 90% of assets under management at institutional firms were actively managed, meaning they were considering the things, Joel, that you're talking about. There was a distinct focus on whether businesses were performing well, and that you would look at revenue and margins and net income. That's the stack, and all the other factors that come into play, your return on invested capital, your return on assets, all those sorts of things. But that considers stocks to be stories. Today, stocks are also products. There is a product that people need. If I'm running a target date, a 2040 target date fund that has a mix of bonds and equities and so on, What I care about is a product that will deliver me a return relative to a benchmark. Maybe it's the S&P 500. And how those companies perform is far less significant than whether those instruments that I want to own are properly tracking a benchmark. That becomes the sole consideration for an index investor. An index investor does not care how a company performs financially. They care whether this stock is within 2% of the benchmark. I want no more than 2% variance. By the way, that's about what intraday volatility is. And the more volatile something is, the less helpful it is to me as an index investor, because it will vary from the index, and I want to track the benchmark. And that, Joel, is why the market cap becomes more significant than underlying fundamental performance. The more of that product I can get, the better. And the market craves them. This is why we tell public companies on the corporate side of our business, you need to figure out how to get yourself over that bar. Why? Well, if you're going to be a public company, your job is to create shareholder value. And that doesn't mean telling your story to more investors. It means making your product appealing to what the money is doing. And so if you have 500 million in market cap, you need to figure out how to create 5 billion in market cap by deploying shareholder assets effectively. And you need to think about being a product, not a story. That's the reality. Do I like it? I don't know. It is what the money's doing, right? And so traders, you have to know that too. It's your job to understand how the market works.
I mean, ETFs are a driver. We've had this conversation with you too, Tim. I mean, they're the driver for everything, even to our trading is to a certain extent at Bright Trading. There's a lot of traders that are doing ETF arbitrage. And I mean, you just got to know. And, you know, we look at these Russell days and we see these wicked moves, we fade them because they typically are going to come back in, you know, because the ETF's got to move enough too. There's some opportunities even on those closes. But I mean, ETFs are driving everything. You know, and even in the extreme example where I've looked at, you know, on these big days where you got Facebook gapping up, but the Qs aren't up that much. And then they got to slam CSX and they got to slam the non-tech component of the Qs to try to make up for the difference. You know, it's kind of messed up to think, oh yeah, CSX was up because Facebook was up. Facebook was up too much, so CSX was down because of that. The media would never talk about that, but that's the ETF effects.
You are absolutely right, and we track that data too. Here, I'll give you 3 interesting data points around that. Cool. So if we look at the 11 sector ETFs year to date versus the composite stocks that make up those 11 sectors, the average stock is up 19%. The average sector ETF is up 20%. But the average variance, the standard deviation between those two, standard deviation, by the way, is 200 basis points between stocks and ETFs. But the average spread is 12%. Where it really stands out is staples. Consumer staples is way out of whack. So here's an arbitrage trade, people, if you want to look at the ETF versus the stocks. The average Staples stock is up 18.8% year to date, and the Staples ETF from State Street's up 7.4%. All right, what is going on? Well, their basket is wrong. Exactly. So there's a huge arbitrage opportunity just week over week. So you back up 2 weeks ago, remember, people forget the stock market was down about 3%. And so then it recovered 3% last week, roughly. But ETFs only recovered 2.4%. Yet another arbitrage trade. And I'm telling you, folks, the market makers run very sophisticated models, and they're very aware of where those gaps are, and it will influence what they do, just like you do, Dennis. You're gonna, you're gonna know where the gaps are and where the opportunities are, and that becomes a principal pursuit of the marketplace. And traders, this is why we created Market Structure Edge. You can go there, marketstructureedge.com. We did this to arm you with that same data that the market makers are going to use, that, the Citadels and Virtus and Two Sigmas and Quant Labs and Infiniums and GTSs of the world, maybe names that you've not heard of, but they're very successful. Jane Street, perhaps the most successful high-speed trader and ETF market maker ever right now. And names you've never heard of. Well, they're doing that. They understand these things that we're talking about right here.
Tim, before we let you go, what was the news you wanted to break? And if you had it, because I'm about to. If you're going to do it, I've got a little.
Okay, so you need the little drum roll ahead of this. Breaking news here on the Benzinga Pre-Market Prep Show.
Yep.
And it's this. There is a belief among the Reddit mob that the reason you can get stocks like GameStop and AMC and pick Clover Health, pick your thing, can move is because of short interest. It's a false correlation. Has nothing to do with it. It doesn't matter with this, whether there's high short interest or low short interest. What matters is whether there is supply in the market or not. And short interest does not determine that. Shorting is supply. So the absence of it is what creates movement in stocks. And those are the rules. I went through this with the boot camp folks.
This is right.
I took them right through. So you could apply it to anything. I'll even show you. So here, I'm going to pull up the Benzinga June 28 portfolio. This is for today. And I talked about this on the boot camp, that the reason stocks move is because market makers must create shares to meet a surge in demand. I read the language straight from the SEC. I'm not making this stuff up. All right, the regulators want a continuous auction market of 100 shares at the bid, 100 shares at the offer. And what if they don't exist? I explained that if GameStop's shareholders own 100% of the outstanding stock and they neither buy nor sell, how is it possible for the stock to move? Well, because market makers manufacture stock, not because they can, but because the regulators require it. They must fill trades with stock. Well, they don't have to locate shares to short, they just create it. And that's how stocks rise. So let's take a Braxis Peak Corp right here. Here's a little energy company that is 50% short. And here's how it moves. When there is no supply, see this trend line here? When short volume drops below the trend line, the stock's gonna move. It has nothing to do with short interest. When the short volume moves above the trend line, now there's more supply and demand can't increase anymore, the stock's going to go down. And it did not rise further than here. And then it will happen again. Short volume drops below trend, price rises. For short volume rises above trend, price falls. And that's what happens. That's how it's all about supply and demand. So traders, knowing this information, you can use it to your advantage. And market structure edge mob, I hope you use it to your advantage. I'm not saying that, look, this is a very illiquid stock. It only trades, and we measure this, it only trades, look at this. So it's 2.6, trend up, 50% short. It only trades $788 at a time. That's very risky. It'll create a lot of movement. Look at GameStop above that. It's 10 times more liquid than is AXAS, because it trades almost $9,000 at a time. Isn't that interesting? It's become a fairly liquid stock. But these are things you should know. You can't, and they're the rules. The rules say market makers are going to have to manufacture stock. So if I try to buy something, for instance, I traded Virgin Galactic last week, made 15% on it, and I did it purely because of market structure. I didn't do it for any other reason. I don't gamble. I look at the supply and demand and I said, well, so supply is stable and demand's rising. What will the price do? It will rise. And so, but my trade, I bought 100 shares. That's it. And it split into 2 trades, both of them executed in dark pools. That told me immediately there's no supply in the market. I couldn't even fill 100 shares. And I showed my Interactive Brokers account to the folks at the boot camp, but to show that that's how that trade executed. And that is your breaking news. It is all about supply and demand. Short interest is a 1974 measure. It has nothing to do with it. It's a false correlation.
Tim Quast is the founder and CEO of Market Structure Edge. You can always learn more about what he's saying on that platform. Tim, always a pleasure. Thanks a lot.
Good to see you guys. I'll keep an eye out for bears.
Yeah, you do that.
We're looking for them. There isn't a lot to be found around here, and at least not in the New York market, I'll tell you that much.
I agree, and I think it may be a good week. There could be a little turbulence June 30, because that's the end of the quarter, end of the month. There's a big futures contract that expires, but otherwise the data say the market continues to rise. There's no question.
Jobs number on Friday, too.
Exactly. Yep.
Right.
Yep. Have a good one, guys. Good to see you.